Good morning, good evening, wherever you may be, whether you're across the nation or around the world. My name is Shane Squark, and on behalf of the CMT Association, I am pleased to welcome you back to another great webcast as part of our educational web series. Today, on May 24th, 2023, I'm pleased to welcome David Lundgren, CMT, CFA, back to the program to present the 4 Ps of investing. As always, we welcome you to submit your questions throughout the duration of today's presentation using the chat box to the lower right-hand side of your screen. In the interest of time, however, we may not be able to acknowledge all of your questions until the end of the formal presentation. Your participation in today's live webcast does qualify you for 2 CMT Association Continuing Education credits, which will be automatically added to your account if you registered online through the CMT Association website. That said, I am pleased to turn the floor over to David.
Excellent. Thank you, Shane. It's great to be back on. Hopefully everybody can hear me okay. The the topic that Shane had put in on the website and whatnot was had to do with a 3-legged stool, but at a very short notice, I thought I'd change the title, but it's basically the same outcome. But it's the point here is that it's a 4-legged stool, and I believe there are 4 P's to investing, one of which is does not belong with the others, as the title here indicates. But I have the 4 words, which is psychology, philosophy, process, and prediction, sized according to the degree of emphasis that people give them in their own investment lives, meaning that most people think that prediction is the most important thing. And I will have a lot to say about that, but truly it is a 3-legged stool. But I also, again, I have them sized according to the amount of emphasis people put on each. And you'll notice that psychology is barely legible because very few people appreciate the importance of psychology in investing. So we'll talk about that and more. So we're going to talk about the 3 that do matter: the philosophy, the process, and the psychology. With respect to philosophy, this is just my philosophy. This is how I think about it, about investing, non-passive management, and how I speak to my clients about my philosophy. So I'm just trying to give you a sense of one person's philosophy. Take from it what you will, take it exactly as you want, or come up with your own version. But this is how I think about it. And so that is that the index, which we'll get into more details on each of these, but the index is just another strategy, and it's a bad one at that. Fundamentals, not opinions, matter more than trend. Sounds controversial for a technician, but nonetheless, you'll see what I mean in a moment. And then the market is the best fundamental analyst on the planet. So let's listen to the market. As respect to process, which is risk management, entry, exit, things like that, what we need a structured process for listening to the market. Again, the market's trying to tell us everything we need to know. We just need to listen. So we need to come up with a structured, unbiased, non-emotional way of listening to the market. And I will share with you my process. Again, take it exactly as it is. You can reach out to me for more detail. But the point is, I would just advocate for being as much as structured as possible in your decision-making. Also, we need a structured process to help us distinguish between good and bad volatility. So not all pullbacks are bad. Some pullbacks are good, and we need a process to help us identify which ones are good versus bad. And then lastly, this is my process. So the name of my company is Motor Capital Management and Research. And the motor stands for momentum and trend. And so what I do both in the research product that I have as well as in the hedge fund that I manage is I combine momentum and trend. And I'll explain, why that is and how I came to those 2 inputs. But trend following works, but it has its problems. Momentum also works, but it also has its problems. So what I suggest is putting the 2 together, because by putting the 2 together, you accentuate their positives while at the same time backstopping each of their negatives. And then the psychology, no predictions. This is a really difficult thing to come to realize as an investor. No predictions, but it's also it's an expensive thing to come to learn if you don't heed the advice of others. And so predictions is a really tough game. If you spend any time following predictions, I would advise you to spend just as much time following up on them, and you'll come to realize that there's very few people that can actually predict anything. So the point is that knowing what is happening is actually far more important than predicting what will happen. And plus, as I say here, we can know what is happening with the most minute detail. And I'll show you how I do it, just by asking the questions of the market that actually matter. But we can never know what will happen. And so therefore, it makes no sense to spend any time predicting the future, because it's virtually impossible. So the most important thing is managing expectations. Although it's the most important, it's also the most overlooked, as I said earlier. So obviously, you have to have a process that works. Having the best mindset and the best managed expectations is not going to make a bad system work. So there's no question that you need a good system in order to make money over time. But what we have found, even with the turtle trading experiment, which was done back in the 80s, is that you can give a whole bunch of people the best trading system on the planet, coach them by the best trend follower on the planet. And in this case, it was 20 people. And for some reason, only 3 or so of those 20 people actually went on to do well, despite having this amazing process. And I had the opportunity to speak with Jerry Parker about this, who's one of the most successful turtles in that experiment. And it comes down to expectations. So that's why I spend a lot of time on it. And I hope to make that point to you today. A really important thing, I don't know if it's underappreciated, but it's certainly very difficult to do, but it's identify the regime that you're in. And I know that's a very difficult thing, but most things worth doing by definition are difficult. So the idea is to try to find a way to properly identify the regime, because the type of regime you're in significantly determines what kind of expectations you should have. And so obviously we've been in a bear market, internal bear market, for 2 years, and a sideways range for at least 1 year. So what kind of expectations should you really have in that environment, right? And then the other thing too is that we know for sure that in a really strongly trending market, either up or down, momentum works. And so if you're a momentum investor or a trend following investor and you're struggling, let that be feedback to you that's almost like a regime identification module itself. Is how, assuming you're executing properly, how well are you doing? And if you find that you're not doing well, that's a good time to back off, risk less, go fishing, do something else until the regime is better aligned with your process. So the idea is let what is happening dictate your expectations and hence your actions, not what you want to happen. So we all want this bull market to get underway again and to start, so that we can start having a positive experience with trend following. But that's what we want, and that's just not what the market's giving us right now. So therefore, it's most important to recognize and acknowledge what is happening and let that dictate your expectations. And when you do that, it's almost like it almost frees you. It frees your mind and your emotions to just accept what is and then do the proper thing for that environment. So on philosophy, I am obviously a big advocate of not, at least not having the all of your assets in passive strategies. In fact, I don't have any in passive strategies, but I can accept that others would want some. But let's say that I came to you with this really great strategy that I've located and identified and did a lot of statistical work on, and this is how it looks. So it's a great strategy. I love it. It has multiple 30 to 50% declines. Several times it has actually spent more than a decade underwater, meaning that you have a high water mark and then it's another decade before you start making money again. And by the way, it's got a maximum drawdown of 86%, and the annualized volatility is near 20%. So that's pretty high. And you get all of this in exchange for a 10% return. I think if you went to any investor, any allocator, and described to them that strategy, they would say to you kindly, thank you, but no thank you. I'm going to move on to just keep my investments in a passive strategy, because I don't want anything to do with that. But what they don't realize is that is a passive strategy. That's the S&P back to the early 1900s. And so to me, there's a lot of things that are wrong with just passive strategies, blindly accepting what the strategy delivers to you from day to day, week to week, month to month, not the least of which is this volatility. I mean, this is just an unacceptable return stream to be underwater for 13 years, 12 years, 25 years, 30, 40, 50% declines, 86% maximum drawdown. So for this reason, I think it's worth looking to alternative solutions to just being fully passively invested. The other issue with passive investing is that there is no risk management going on whatsoever. So when you look at the constituents of the Russell 3000 back to 1980, so it's 40 years worth of data here, nearly half of them, or 42% of them, actually experienced negative absolute returns while they were in the benchmark, which means that there's a significant percentage of stocks that when they go in the benchmark, from the moment they go into the moment they come out, that they actually lose money. And then one might ask, well, if there's that much of the market is constantly losing money while they're in the index, how on earth does it make money? The reason that the index does well over time, or at least generates returns over time, is because there's these capital compounders, or the right tail events. And these are the stocks that are a very small minority of them. It's about 10% of them that we all know today, because we can look back with hindsight and know that it's Google, Amazon, Netflix, Microsoft, et cetera, that they do so well. They're these massive right tail events. They do so well that they pay for all the mistakes that the benchmark makes by not managing its risk and taking care of everything that's on that left tail. So anybody that does trend following knows that the whole point is to get rid of the left tail and try to find the things on the right side. So that the reason we can do well is because there is a positive skew to the index. So many, and I agree, many would say that passive investing is actually a momentum strategy. It lets the big stocks get bigger and bigger and never sells them. The problem is that while it's doing that, it also does nothing to manage risk. So what I would suggest is that we come up with a way to identify those right tail opportunities while at the same time managing risk. So that's what I find to be wrong with passive investing. It's why I've dedicated my career to trying to deliver better alternatives to investors. So the other part of my philosophy is this notion of fundamentals. And I'm a pure systematic trend follower. Does that mean I don't believe in fundamentals? And I will just tell you that there is nobody on this planet who believes in fundamentals more than I do. And I'll show you why that is right here. So in the short term, when you're looking at roughly 1 year periods, almost half of what happens to a stock in any given 1 year period is a result of expansion or contraction of valuation. So if you ask me what the best sentiment gauge is, it's valuation. On one week, investors are willing to pay 10 times earnings, and then 6 months later, they're paying 30 times earnings. That's sentiment, right? It's confidence, it's optimism, et cetera. So that's when you're looking at what drives a stock in the short term. But then when you start going out 3, 5, and 10 years, the valuation expansion and contraction drops to 5%, meaning that 95% of it is left to fundamentals. And almost 3/4 of that is top line revenue growth. So this is just, if you ever wondered if fundamentals matter, this is proof positive that not only do they matter, they're actually the most important thing. But what I would say is, of course, is that the better the fundamentals, the better the price trend. So when somebody asks me what's more important, fundamentals or price trend, I would say without hesitation, fundamentals, because without strong fundamentals, there are no strong price trends. They're joined at the hip, right? They're inseparable. But there's a big distinction between fundamentals and opinions about fundamentals. And so this is a very unfortunate but true slide that goes back again, back to March 2020, and it shows that over the prior 15 years, 88% of the actively managed funds that use fundamentally oriented active strategies have underperformed their benchmark. And these are people who use fundamentals. They enforce their opinion upon the market. They forecast. They believe the market's wrong. All these things that they're trying to do to quote unquote beat the benchmark. When of course we would just advocate that you should just do a better job of listening to the benchmark, because clearly it knows something you don't, because it's beating 88% of you. And by you, I don't mean you guys listening, of course, or gals. Of course, I mean those that just actively try to beat the market with their opinions of the fundamentals. So the fundamentals matter, but clearly opinions don't matter. In fact, they can be hurtful. So the question is, if fundamentals drive long-term trends, why not just use some combination of price and momentum to listen to the market and let the market do its job for you and find those best fundamental opportunities vis-a-vis, and it will display them for you vis-a-vis price trend and momentum. So here's a dirty little secret too, by the way. We are actually all trend followers. So whether or not you're a devout, systematic trend following investor, or you're a value investor, or a systematic quant investor, macro, whatever it is, you're actually a trend follower as well, even though, like, in other words, we all are. We're the only ones that will admit it openly. But let me explain to you what I mean. So if you were to detrend price and just put it on a sine wave like this, and of course you have the average of the trend. So in the case of technicals, this could be the 200-day moving average. In the case of valuation, that could be like what you consider to be fair value or average value. Of course, anything above that is an uptrend, or in the case of valuation, overvalued. Anything below the average is in a downtrend. And anything that's in the bottom left-hand corner of this diagram is where you'll find companies with poor fundamentals and probably, if possibly, contracting valuation. And what you'll find up in the top right-hand corner is weakening fundamentals or in contracting valuation. So there's nobody that obviously comes to work every day trying to capture poor fundamentals in contracting valuation, or the alternative, right? What we're all trying to do, no matter who we are, we're all trying to capture this part of the trend, whether you're a trend follower, openly stated as such, or you're a value manager trying to capture this trend before it happens by trying to buy something cheap before it gets expensive. No matter who you are, this is the exact segment that we're all trying to capture. And guess what? This is where the improving fundamentals and expanding valuation are. So here again is just the proof positive that we are all trend followers. We're all trying to capture the up part of the trend. It's just that, you know, we're the ones that openly admit what we're trying to do here. So in essence, value managers, because of their bias to buying things that are cheap or inexpensive, start to buy here. Because of their valuation framework, they begin to sell here. And again, by the way, I'm not criticizing any of this. I'm not criticizing macro investors, systematic quant, or anything like that. It's just another way to try to, you know, beat the market over time. And this is what it looks like to be a value manager. They begin to buy early and they begin to sell early. And again, we all know value works over time. So this is not a criticism. I'm just basically stating what is. So at the end of the day, value managers begin buying early, which exposes them to large losses. So if you thought it was cheap at 12 times earnings, you're going to love it at 8 times earnings. And that's the story for value managers. If you can't find a fundamental reason for it to have gotten cheaper, then you just buy more. And so you end up with these exposure to these left tail outcomes. And you also begin selling early. So you forego those large gains, those right tail events that really pay for all your mistakes. So at the end of the day, value managers have what's called a negative skew, where they have a lot of left tail events and they have fewer large right tail events, but it works over time because their hit rate tends to be more right than wrong. So you just a simple math, you do that math and they can make money over time. But this is, again, not a criticism. It's just explaining what it is. Trend followers, on the other hand, we start buying here and we start selling here. So for us, we begin buying late. We never buy the lows. We never make it, at least in my process, I never try to buy the lows or even identify the lows or anything like that. I also begin selling late. I never try to high ticket or sell the high. The whole objective of trend following is to try to identify the trend turn and capture as much as the trend as possible without forecasting how long it will last, and then just exit when the trend ends. As a result of doing that, we end up with a positive skew, meaning we have access to those right tail events that can really drive returns over a long time. But because we're constantly managing risk when we're wrong, we end up with a large stack of small losses, but we don't have a left tail. So put these two attributes together of trend following and you get a positive skew. And again, they both work over time. It's just very different. It's just a different experience. And so therefore, this is why it's important for investors to make sure they match their personality, if you will, to the strategy they're deploying, because clearly they're very different. So the idea, though, is that if the market's the best fundamental analyst on the planet, and it expresses its identification of those great fundamental opportunities vis-a-vis trend, then what we want to do is the change in the fundamentals is the catalyst that unlocks that undervalued condition in it's signaled or triggered by the change in trend. So when we buy something that's trending in the weekly and monthly time frame, we just make the base case assumption that the market's found a good stock, good fundamental company, and we're just assuming that the fundamentals are good. And oftentimes we find out why later. Oftentimes when things start to really trend in a fundamentally driven time frame, we find that we find out the reasons why later. And I'm okay with that, obviously. So trend following is about listening to the market, right? So identify those time frames, like this is a weekly chart, identify those time frames that are driven by fundamentals, like big, strong trends don't happen on the weekly chart unless there's a fundamental trend underpinning it. I'm not going to spend a lot of time on this slide because I'm assuming that most of you are technically minded, technically aware, know how to do this, but this is just a very simple way to identify opportunity and risk, right? So what we do know that as a stock can go up or down for any number of reasons fundamentally. Even the same stock from cycle to cycle can be completely different reasons for the stock to go up or down in any given cycle. And the toughest part about it is that the fundamental reasons can actually, and they do change from cycle to cycle. And most people actually disagree with what the fundamentals are at the same time. So like why Tesla went up, everybody was in disagreement about it. But some people said it was the electrification. Some said it was the batteries and how he's going to change the way the country and the world powers their operations, their mode of transport, and others said it was solar panels. And so, who knows what it was, but we know for sure that in this framework, it went up a lot. So we don't really know fundamentally from point to point or cycle to cycle what the drivers are. But my point is we don't need to know. But what we can say for sure is that these 4 boxes must be checked every single cycle. And I refer to them, they're so important and so unavoidable that I refer to them as inviolable rules of trend following. These 4 things, like there are no guarantees in this business, but these 4 things must happen. And so the 4 things that must happen, of course, are a trend line break, violate the last high or low of the prior trend, 50-day crossing, the 200-day, and then the 200-day turning up. So you can see that unfolding here. So there's your first box checked right there. Second box checked right there. Third is the crossing of the averages. And then fourth is the average itself turning down. So once you can check all these boxes, the market's telling you as the best fundamental analyst on the planet, there's risk here. Fundamentals have changed. So sell, no more buying. And now you can take that exact same process, which is what's great about technicals is that it's a very flexible process in the sense that it works. It helps you on the upside as well as the downside, which you really can't say about other strategies. But the idea is to wait for the boxes to check in the other direction and heed the market's advice, and then conversely wait for it to break down again with no forecast as to when that will happen. So this is using price to identify risk and opportunity in the market. And so price is great in a really strong bull market. This is what most stocks look like. But the problem obviously is that with price trend, if everything's trending, you don't know which one you should own. So how do you know which of these uptrends should you own? And that's where momentum comes in. So momentum is a strategy that's been back tested all the way back to the early 1900s. And most of you are familiar with this, so I won't get too far into it. But these are the top deciles of momentum all the way down to the bottom deciles. And so this is showing you how these momentum deciles have performed over time. And these are the stocks with the best and worst momentum over time. And what it demonstrates is that the stocks with the best momentum over the past 12 months do the best going forward, and stocks with the worst 12-month momentum do the worst going forward. So the idea is if you're trying to beat the market, fish where the fish are, right? If you're trying to win a fishing derby, go to the pond where all the fish are. In the case of momentum, that pond is these top 3 deciles of momentum. Okay. But putting these 2 together, the problem with momentum is that if even in a bear market like this past year, you're constantly ranking the momentum of every stock in the benchmark, and in a really bad bear market, that even the best performing stocks could still be in a downtrend. So that's the problem with momentum. So momentum does a great job when you're in a bull market. It identifies those stocks you want to own that are doing the best. But in a bear market, it keeps telling you to stay long, even though everything's in a downtrend. So by putting these 2 things together, momentum and trend, you end up with an approach that looks more like this. So you're focusing on positive price trends here and positive relative performance here. And so in a bull market, this is leadership. And in a bear market, these are, in this case here, if you've got an absolute price trend that's negative and you've got negative momentum, these are the negative trends, and underperforming, these are laggards. So this is a good place to source short ideas. this is a bit of a conundrum. What if you've got positive price but really bad momentum? Well, this was 2021. There were lots of stocks that were like that. Had a great looking chart, but it was underperforming. So it's okay. Just don't own it because it's not leadership. And then this is the biggest conundrum of them all. We saw a lot of these last year where there were a lot of negative trends, but the market was so bad that the negative trends were still outperforming. So again, what you're trying to do with your process is you're trying to identify things that are in the top left-hand corner, because that's the market telling you this is the best fundamentals. And so this is the value of putting these two things together. So that's just a quick rundown of the philosophy and the process. Obviously, the process is a lot more detailed than that. And you can ping me on the side. Check out my website where there's a lot more discussion around it. And there's an opportunity there for the folks on this webcast to also get a free 1-month trial to the research, so you can dig into it a little bit. Hop on the phone with me and we'll walk through the process, et cetera. So if you're interested, please take advantage of that. But let's talk now more about philosophy, right? Because again, I think this is the most underrated, but perhaps the most important part of what we're doing here as investors. And it's all about expectations and mindset, and having trust in your process, and just having the belief that the process that you've put together is knowingly intended to guide you through all these different environments. So when you can identify which environment you're in, just trust your process to guide you through it, and don't try to forecast it. Don't try to force the process to do something that it's not supposed to be doing in the environment that you're in, and all these things. But that's all mental, and it's all psychological and mindset. But it's as I said earlier, you can have a great strategy. I mean, whether it's value investing, growth investing, macro, all these different ways that you can invest. We can go through history and find lots of people over time that have done a great job in each of those different ways of investing. But if we have all these ways to invest that are demonstrably true, I mean, there's a lot of people that have done well over the years with using these different strategies. If all these strategies exist and they work, then why are we as individuals struggling to replicate or duplicate those results? And I would say it's because the missing ingredient is mindset. So it's not the process. Yes, you need the process you're deploying has to work, obviously, but it's not the most important part, because there are many instances. The most glaring one to me is, as I said earlier, was the turtle experience, where, I mean, you were literally taught the best trading strategy possibly in history by one of the best trend followers, certainly in history at the time and probably since. And yet very few people came out of that experiment with any degree of success. Why is that? Well, it's mindset. So in preparation for that interview that I did with Jerry Parker at the CMT Association's 50th anniversary symposium in New York, I put this question out on Twitter, and just to see what people said before I had this discussion with Jerry. And it's good to see that 65% actually said that money management and money and risk management was the most important. So at least they put a lot of weight on that, because it is very important. But I just want to draw your attention to personal mindset was only roughly 20%. Got the most important response. And I think that this is largely reflective of how people actually think about investing. And so for this reason, we don't give enough thought, no pun intended, to the value and importance of mindset every single day. So let's dig into this a little bit more. So really what it comes down to is, what should you actually expect as a trend follower or as an investor of any sort? What should you expect? Because a lot of times what we find when we have a lot of anxiety and angst about what's happening in the market and what's happening in our portfolio, it's just because there's this massive disconnect or sort of Grand Canyon between our expectations and what the market's trying to tell us. And what we need to do is do the best we can to align our expectations with what the market's trying to tell us, which I said earlier was just, don't forecast, just look at what is happening. If you can become an expert at identifying what is, you're leagues ahead of most people, because everybody's trying to focus on what will be. And we already know that very few people can do that successfully. So the idea is to focus on what is, and that'll put you in a proper mindset to deal with what is, and then know how to manage your risk, how big you should make your positions, how engaged in the market you should be, should you have short exposure, things like that. So it all comes down to expectation. So think about it this way. We're familiar with these concepts: cut your losses short, let your profits run, right? This goes all the way back to the 19th century. So this is not a new concept. But again, we have a hard time heeding this advice, even though this is old advice that's stood the test of time. So if you're a trend follower, and I advise you all, if you're trend followers, to do what I'm about to show you, because it, number one, tells you how effective your strategy is, but it also anchors your expectations properly to what you should expect given your process, especially if you have a profitable process that works over time but has a low hit rate. So let's assume that every month you take all of your trades and you just start stacking them on this distribution curve. Obviously, everything to the left is a loss, everything to the right is a win, and you'll see that there's just an awful lot of losses. If you're executing your strategy day to day, week to week, and you're not expecting this, and you are exposing yourself to the very high likelihood that you're going to improperly execute your strategy and start to question your strategy, thinking something's wrong, when in fact the strategy is doing exactly what it's supposed to do. Today a lot of people are saying that trend following is not working, and I just think that is a massive mischaracterization of what's actually happening today. What is trend following? Trend following is two things. It's identifying those environments when you have an opportunity to isolate and identify those right tail events. And there's nothing better than trend following, as far as I'm concerned, at identifying and riding those right tail events. But the other half, and again, this goes to show that very few people think about this, but the other half of trend following is to protect yourself. Dig small holes when you're not doing well. Make sure that you have a large stack of red dashes over here instead of left tail events, right? That's the other half of what makes trend following so great. So if you ask me, is trend following working? It's working in spades. It saved my bacon this past year. My drawdown is way less than the market. And the reason is because trend following is working. So that's my expectations, right? So my expectations are perfectly aligned with what's happened this year. And so knowing that we're not in a bull market, which we'll talk to in a moment, knowing that we're in a range at best, possibly still in a bear market, what should I expect? Well, I should expect a lot of red lines over here. And guess what? I have a lot of red lines, more so than normal. So like over a full market cycle, if you're really, really good at this over a full market cycle, so meaning a bull market and a bear market, if you're right 40%, you're solid. If you're right 50%, you're very good. In a bear market, it's more likely that you're going to be wrong 70% of the time. So think about that. If you're not expecting that, right, in a bear market, you're going to be wrong 70% of the time. If that's not your expectation, you're going to think there's something wrong with trend following. Trend following is not working, and you're going to miss the point that there's economic value in all those little losses, right? It makes sure that you don't have these big left tail events. So don't confuse high frequency of small losses with trend following not working. It's working just fine. It's doing its job. You just have to let it. And so if we look at this diagram, maybe I should finish with the idea that in a bull market, which is obviously the corollary to what we're in a bull market, your hit rate can go to 80, 90%. I mean, in 2021, I think I had the highest hit rate I've ever had in my career. And was that because I was a genius, or was it just because the other half of trend following was working? I would tell you that it's because I'm a genius. No, it's not because I'm a genius. It's because trend following, the other half of trend following, was working, right? And so, but we do get that trap. We fall into that trap of thinking that I'm so brilliant because look at how much money I'm making, and we lose sight of the reality, and our expectations begin to separate from the reality that this is just what the market's delivering. It's just what trend following is delivering right now. It's not because you're a genius. It's because the other half of trend following is working. So always keep your expectations properly rooted in what trend following can deliver over time, and then you won't think that you're a complete idiot in a bear market, and you won't think that you're a complete genius in a bull market, right? So when you look at this diagram, we're all familiar with this schematic, but look at that first quote: "Cut your losses short and let your profits run." That's what this is. Positive skew. Cut your losses short, let your profits run. This is trend following, and this is why it works over time. But it's also why it's extremely difficult to do if you don't have proper expectations. If you're not expecting the possibility that you'll lose 60% of the time. And I'm assuming most of you know this on the call here, but As long as your gain is 2 to 3 times larger than your average loss, you actually will win, as demonstrated here in this example. So this is why trend following is very difficult to do. But in a bull market, it's why everybody gets attracted to trend following, because it seems so easy to do. But it's also why so many people flush in and out of this strategy. A lot of people are abandoning and giving up on trend following because of what's been going on the past year. But trend following, as far as I'm concerned, and the way properly deployed using both trend and momentum together, trend following outperformed buy and hold last year again, because that's what it's supposed to do. And then when the bull market resumes, we'll probably lag off the bottom because we're not supposed to outperform off the bottom. That's part of trend following, right? That's, again, anchoring your expectations to proper outcomes and things that are most likely to happen in the strategy you're deploying. It's a whole sort of rabbit hole discussion about momentum crashes, which if you have questions about it, I'm happy to answer. But momentum crashes, trend following does not perform well during those. So that when it happens, don't think momentum's broken. Expect it, right? And that'll get you, in the proper mindset to stick with trend following in those moments when it's quote unquote not working. So all we can control as investors, no matter who you are, is of the 4 possible outcomes. When we buy something, you can either have a small win or a small loss, a huge win or a huge loss. The only one that we can actually control is to make sure that we don't have those left tail events, because we can't control huge wins. We can't control which one's going to be huge, which one's going to be small, or which one's going to be a small loss. But what we can do is we can cut off these huge losses. So by doing that and just being mindful of those periods of time when you're likely to get a lot of small losses relative to a lot of large gains, and just have that properly anchored in your mind, you'll be able to execute a strategy like this over time. I think if there's questions on this, I encourage you to ask. Go ahead and put some questions in the chat room there, and we'll address it later. But this, you can see, particularly as the cycle changes from bear market to bull market, how your expectations have to be unchanged. You have to have expectations for both regimes, and don't let the changing regime, make you think you're smart or stupid. It's the strategy, right? So here's how I identify the regime that we're in. So I have what's this gauge, which I refer to as the risk gauge, and it's the entire gauge. The whole research process is based on those inviolable rules of trend following. So just to kind of anchor your understanding in terms of what I actually mean about that, and think about that trend change chart that I showed you earlier, is if you have a stock that you think maybe fundamentally you love the company and you think it can go to 50, and it's trading at 10 right now. I can guarantee you that it's not going to go to 50 unless it goes past 11 first. So that's an inviolable rule of trend following. And I just would suggest that you try to structure all of your thinking around concepts like that, because everything else is a forecast. And other things like sentiment is not one of the things that's in my risk gauge, because sentiment doesn't always work. Last year was a perfect case in point, where in many gauges that we had been following last year from a sentiment perspective had reached record degrees of bearishness, and the market kept going down anyway, right? So for that reason, I follow it because it's important, but it's not in the risk gauge because it doesn't have to work. Things like valuation, what the Fed is saying, what the yield curve is doing, what interest rates are doing, none of that is in the risk gauges, because it doesn't always have to be true from cycle to cycle, whereas these concepts must be true. They're inviolable, right? So this entire risk gauge process is based on those rules. So trends are fractal, meaning that the quarterly time frame, you see here, there's 4 time frames: quarterly, monthly, weekly, and daily. The quarterly time frame can't get better unless the monthly gets better first, on down to the weekly, on down to the daily. So if we're in a bear market, quarterly time frame looks terrible. That quarterly time frame can't get better until the daily gets better first. There's a lot of power in that statement, but it's also true. You cannot go into an uptrend on the quarterly time frame unless the daily does, right? So being able to monitor the evolution of trend vis-a-vis these four time frames across these different inviolable rules of trend following is a really powerful way to anchor your expectations, and therefore develop a proper mindset for what's happening in the current environment. So the 5 inputs that go into each of these 4 timeframes, it's all 5 of these go into each of these 4 timeframes, these are all inviolable. They happen at all cycles, bull and bear, and they have the same attributes during the different cycles. So it's price trend, relative trend, momentum, breadth, and volatility. Those 5 things are pretty much all I care about from a modeling perspective. So all 5 of those are in this gauge across the 4 time frames. And so basically by looking at this gauge, I can, in the morning, after I run my models and update this, I've basically just done a comprehensive chart review, because the process is modeled to capture what we know to be, uptrends and downtrends visually, 2,500 stocks across 4 timeframes using these 5 inputs. I can't do that possibly, personally, visually, within subjectively looking at charts. So that's the value of, one of the great values of technical analysis, is how it scales the research process. So when we do this, also we can also do it at the sector level. So what you see here is the risk gauge for the entire market. We can also create a risk gauge for every sector, and we know which sector is the best ranked sector, and then we can look at the risk gauge for the best sector. And right now, the best sector right now, everything I do obviously is equally weighted. The best sector is industrials. Even the best sector barely has anything in risk on. So that tells you something about the environment. When we're actually in a bull market, in a risk on environment, the top 2 or 3 sectors are going to be pinned to risk on. We're not there, right? So we're in, at best, a range bound environment, which obviously, as you know, that is more of a mean reverting environment. So temper your expectations that way, because that's what the market's telling us, right? I'm trying not to enforce my desire for a bull market upon the conditions that we have now. I acknowledge and recognize that what we have right now is all 4 timeframes across 2,500 stocks, and these 5 inputs, they're all mixed. So I can fight that. I can be unhappy about it, but none of that's going to change what it is, which is mixed. So let's just acknowledge what is and do that, instead of try to enforce our own will and desires upon the market. So as I said earlier, these models are all driven based on breadth and from the bottom up. So every stock gets a score and a rank, and it kind of bubbles up into these risk gauges. So this is the reason I do it this way, is because, as most of you again know, is that the major price turns in the market, they tend to happen beneath the surface before they happen at the index level. So breadth and things like that tend to bottom before the actual index bottoms and breaks out and things like that. So ideally, if history repeats, we'll start to see things going into risk on across the daily, weekly, and monthly timeframes before the market itself is actually showing similar progress, right? So having said that, there's also value in noting that the risk gauges happen to match rather perfectly what's happening in the market right now. So we know that these, if you follow me on social media, you probably have seen this. I've posted this chart a number of times since back in November. And, we don't really need too much of a modeling process to know that we're stuck in a range, right? So if we're stuck in a range, then let's just accept that, and let's just go with that. And what do you do in a range? Well, you kind of you sell overbought conditions, and you buy oversold conditions, or you sell calls and when you're overbought, and you sell puts when you're oversold. Those are the kinds of strategies that you should be deploying right now, and they should be working out for you right now. But when the regime shifts, those exact strategies you need to throw out the window and become a trend follower, right? Because none of that works. You can't sell calls on an uptrend. And you can sell puts in an uptrend, of course, and that's something that I do. But the idea of selling upside volatility is a really bad idea, obviously, in a bull market. So acknowledging and recognizing when the regime changes is a super important attribute to success in investing, but it's also extremely important in helping you manage your expectations. Because if you see this, well, what should you really expect right now, right? You shouldn't be expecting big things on the in terms of right tail events. And so that means that you should have less capital involved. You should have, you should be risking less per trade. Like if you know that there's going to be a lot more red dashes on the left side of that histogram frequency diagram that I showed you earlier, if you know that stack is going to be larger than usual now because we're not in a bull market, then in a bull market you usually risk, say, 50 basis points per trade. If you know you're not in a bull market and therefore there's going to be a bigger stack of red, then why would you still be risking 50 basis points? Why don't you cut it back to 15 or 10, right? Why don't you acknowledge what the market's trying to tell you and just make adjustments for that? That'll help you better manage your mindset, manage the process, and manage your expectations as well. So just finish up with a quote here from Jesse Livermore. I think this is really appropriate for now. There is time to go long, there's time to go short, and time to go fishing. And so you look at this chart, look at the risk gauges, if you're not into mean reverting trading, like I do a lot of selling puts and calls and things like that, that happens to work for me. But if you're a trend follower, a devout trend follower, and there is no trend, maybe now's a good time to go fishing. Okay, so there's this perception that Warren Buffett is the best stock picker of all time, and I think there's danger in just accepting that statement, or allowing that statement to drive what you're trying to do in your process. Meaning that, like, well, if Warren Buffett is where he's at because he's a great stock picker, that means that I need to become a great stock picker, and everything I touch needs to turn to gold. And I've in my presentations over the years, I've constantly said that there's this expectancy formula that everybody has to go through, even Warren Buffett. And what that expectancy formula is your profit is equal to how often you're right times how much you make when you're right, minus how often you're wrong times how much you lose when you're wrong. And you just do that formula. And if it's a negative number, stop what you're doing, because what you're doing is not working. If it's a positive number, keep doing it because it works, right? But so what I've always said is that even Warren Buffett has to live and die by that reality of the expectancy formula. But it really made me smile when I was reading Warren Buffett's annual report from 2022, and I caught this statement. Warren Buffett has, in his 22 report, said, "At this point, a report card from me is appropriate. In 58 years of Berkshire management, most of my capital allocation decisions have been no better than so-so." Now, if you're a devout Warren Buffett follower, you may have had a heart attack hearing your this god of stock picking say something like this. But this is the truth. This is coming from the man who actually developed who actually created the track record that everybody is so enamored with. This is the truth. My capital allocations are only marginally better than so-so. He goes on to say, our satisfactory results have been the product of about a dozen truly good decisions. Sound familiar? That sounds like trend following to me. That would be about one every 5 years, and sometimes a forgotten advantage that favors long-term investors such as Berkshire. So it's about having this strategy that works over long periods of time. But the truth is, the reason he has done so well is because it's about a dozen really smart things that he did well over the past 58 years. Not everything he touches turns into gold. This is Warren Buffett himself. He's not confessing it. He's just telling us what is. So the lesson for investors is the weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders. If that doesn't sound like trend following, I don't know what does. This is the man himself telling us that it's not about being a godlike stock picker. It's about when you recognize you have something good, let it go, right? Cut your losses short, let your profits run. That was stated back in the 18th century, the 19th century, 1800s. So here it is. This is the man himself telling us that it's a lot more about recognizing a good thing and letting it run than it is being a golden boy stock picker. So I thought this might be a refreshing perspective to have to hear from Warren Buffett himself. Okay, so that's what I have for you today. I open up for. I don't know if there were any questions that came out. Maybe Shane can help direct with that. But while we're waiting for that, if you go to my website, motorcmr.com, there's a tab called CMI, which is Charting My Interruption. It's a free commentary that I publish every Friday. And for those that are listening to this webcast, we're also happy to provide a 1-month trial to the broader premium research service as well. So if you're interested in that, in taking advantage of that, please reach out to Rick Casella. His email address is here. He's the Director of Business Development at Motor. And with that, I'm happy to take any questions you might have. Let's see here. Looks like we have a few here. How do the 4 rules interact with momentum? Yeah. So if I understand the question correctly, how does momentum interact with those 4 rules of trend following and the inviolable rules of trend following? What they do is they provide a final filter, if you will, for making better qualified decisions as to which uptrends to buy. That's really the way to think about it. So as I said, in a bull market, in a particularly robust bull market. I think it was 2000. What was it, 14 maybe? Virtually every stock was trending. It was a crazy bull market. Brent was off the charts, no pun intended, or maybe it was intended. But the idea is to then the only way you can winnow down that list of 20, if it's a 2,500 stock universe and 2,000 of the stocks are trending, the only way you can winnow that down is to then run them through a momentum filter and just make sure that you don't have to buy the top decile. In fact, I don't really advocate necessarily that you only buy the top decile, or perhaps a better way to say that is that if you buy something in the top decile and it falls out of the top decile, that's not necessarily a good reason to sell. The reason I would sell is if it falls into the third or fourth or fifth decile from the top, or it actually breaks its price trend. So some combination of those two things is how I use them together, right? So I only buy uptrends. I do not buy downtrends. And I'm focusing on the weekly, monthly, and quarterly time frame. So just because something's in an uptrend on the daily time frame, the value of looking at 4 time frames is that the quarterly and monthly time frame puts into important context the uptrends that you see on the daily chart. So last year, from I think it was June to August, we had a massive uptrend on the daily chart. But if you were properly monitoring the short-term time frames over those other longer-term time frames, what you actually saw was that was a perfect overbought downtrend on the quarterly chart and on the monthly chart. So it was a better time to actually get short than long. So those are the ways that I put together momentum and trend over multiple time frames. So hopefully that answered your question. But please feel free to follow up with me either here or via my email. Happy to follow up if you need more information on that. Position sizing. Talk a little bit about entering and exiting your positions. So for me, I don't leg in and leg out. I'll leg out of a position, but I don't leg in. And the reason I don't do that is because I'd rather just I'd rather know ahead of time that I'm going to, like in a bear market. I'm always trying. This is something else too to really be mindful of, is even if you're in a bear market like we have been, you should always be looking for things to buy, because you all know that the way the market tells you what's going to lead in the future is that it starts leading during a bear market. So if you start to be able to check these boxes in multiple time frames, indicating particularly in it has been very difficult to find like utility stocks to buy or staple stocks to buy in the past year because they're supposed to be doing well. But when you start finding industrials and discretionary names and tech names that are starting to do well in the throes of a bear market, that's the market's way of telling you that that's the future leadership. So from that perspective, one of the lessons I've learned over the years is that you should always be executing your process on the long side. But the way you accommodate for the fact that we're clearly not in a bull market, and so therefore it's a riskier environment, is you just cut back your position sizes at the outset. So rather than leg in, I'd just rather execute the process completely unchanged, do the same exact entry and exit, just risk less, because I know there's going to be a bigger red stack. And one of the things I track is I have measure this trend, that checklist that I showed you, the four items across 4 time frames, and what I do is I can track the moment a stock goes into an uptrend, what's it done since then, and you can do that across the 4 time frames. So if these data points are just fresh in my head now, but if you on the weekly time frame, so I'll address that. But something like 56% of the stocks that have broken out into an uptrend on the weekly time frame are up since then. So almost half of the stocks that broke out in an uptrend on the weekly chart are actually down since they broke out. Now you flip that analysis upside down and I ask the same question on the downside, of the stocks that are in a downtrend on the weekly chart, what percentage of them are actually below where they were when they broke that level that got them in the downtrend? And 96% of stocks are still are actually down from where they were when they entered the downtrend. So what should that do to your expectations? What should you be expecting? You should expect breakouts to fail. Not because I'm depressed or I'm not an optimistic person. I'm actually super optimistic. I can't wait for the next bull market. But what I'm really, truly optimistic in, where my beliefs are the strongest, are this idea that momentum and trend following will work over time. It doesn't work all the time, but I know it will work over time. And that's where my beliefs are. That's where my confidence is. But right now, my confidence on breakouts is very low. Not because I don't think trend following is working. They're low because that's what the data says right now. So because that's what the data says right now, I'm risking less, but I'm always executing. I can't stress that enough. Always execute your process. So if you on the 30-day trial, thank you. If you wish to access that, just send the emails are up here on the screen. Rick Casella. Send us a direct message, and we will tell you how to access the not a direct message, an email. You can either send it to me or Rick. But once we receive your email, we'll give you instructions on how to take advantage of that 1 month trial. So great question. What books do I recommend? So there's actually 4 books that I recommend everybody read, and it's and you probably have already had them. You probably have read them already, and I apologize for restating these same books, but that's the point. That's the point. It's Jesse Livermore's book, Nicholas Darvis, William O'Neill, and Mark Minervini. Those 4 books. Why are they so important? Well, that spans 100 years of real trend following experience. So these guys aren't just guys that wrote books about investing and how it should be done. These guys have actually done it, and so therefore the value that you'll find in a book like the ones that I just listed is that these guys don't just write about what they do, but they also write about the mental anguish that they went through trying to execute the strategy over time. So again, it can't be overstated how important mindset in the mental aspect of this game. When LeBron James was asked what separates him from the rest of the crowd, why is he so good amongst this league of incredibly talented athletes, and he says it's mindset, right? So that's LeBron James, one of the greatest basketball players in history. So I'm willing to listen to the likes of LeBron James, Jerry Parker, even looking at what I just showed you with Warren Buffett. I mean, it's about having this belief in what you're doing over the long term. So I would just, those 4 books, I read them every single year. And every time I read them, I learn something new or I relearn things. But there's no, people that have asked me, why don't I write a book? The truth is there's nothing else to write. They've already been written. And the fact that we're looking for something new tells us, one of the things I try to stress is this notion of listen to your self-talk. So when you ask questions or you make statements, and particularly if there's anxiety behind it, or if you're like you can feel a lot of desire behind that question, stop for a moment, take a deep breath, and analyze that question, because it's kind of telling you a lot of what you need to know. And when people are asking for something more than Jesse Livermore's book, or something more than Nicholas Darvis's book, or something like that, they're missing the point. The point is you don't need more. It's already there. It's 100 years of concepts. They all basically did the same exact thing over that 100-year span with their own little personal tweaks, but it's essentially the same strategy, and it worked over 100 years. So you don't really need more than that. What you need to do is work more on, and I'm obviously not speaking to the person that asked this question. I'm speaking to myself. You need to work as much on your mindset and your willingness to accept what the market's delivering, as opposed to trying to project on the market, which I showed you the slide that 88% of those who try to project their opinions upon the market, does not fare well for them. I hope that answered your question. But again, with all of these, please follow up if you have other questions. We have a couple minutes left here. Yeah, so this is a good question, and it's also this is one. The question is more like a career advice type of a question. When I got into the business, there were, and this is true today, but there were many more specifically technical analyst positions, and so today it's a lot less about like being a technical analyst at a company than it is about being an investor at a company who uses technical analysis. So really what it is about is get your CFA, get your CMT, because the combination of those two things will make you an outstanding investor. And so if I'm thinking purely technical, it's probably like a trading desk where they're kind of in the weeds of supply and demand, which is what technical analysis is all about. But the further away from the trading desk that my career gets, become more like an analyst or a portfolio manager, the more I want to start. Never abandon technicals, because that's the true power of technical analysis. Is it's fungible across timeframes. So what works on the 1 minute chart works on a quarterly chart, right? You can't say that about fundamental analysis. There is no such thing. There is no PE ratios don't matter on the 1 minute chart, but they do matter on the quarterly chart, right? And not always, by the way, as we know. Sometimes they do, sometimes they don't. But trend always matters across all time frames. So for that reason, you should never abandon the idea of being well equipped technically. But the further that your time frame leaves the trading desk and goes more into portfolio management, the more you should be thinking about careers along the lines of analyst and portfolio manager with a combination of price and fundamental. And on that, please follow up with me, because I'd be very happy to help you if I can flesh that out a little bit more in terms of career advice. When we look at something. Yeah. So yeah, this to me is a. I'm sorry. The question is, when a stock gets added to a benchmark, it tends to underperform for a period of time after that, and that's true. But it's also equally true that when a stock gets thrown out of a benchmark, it tends to outperform. So that's the point, though, is that when you see a stock leave a benchmark, you can just look at it technically and see that it should have left a long time ago, right? That was my point earlier. And when you see a stock come into a benchmark, you can look at the chart and say, man, this thing should have been in the benchmark 2 years ago. That's the point. That's why trend following is the answer to the index investing, because index investing is momentum. It's about putting a bunch of 500 stocks, kind of like throwing out a very wide net, and just whatever works the best, just let it just keep getting bigger and bigger in the portfolio. That's trend following. And then whatever doesn't work, well, don't worry about it, because by virtue of it not doing well over time, it just becomes smaller and smaller in the benchmark. So that's their form of risk management. Obviously, we can make the case that risk management can be better managed. So, but what you highlight is very true. And then lastly, I think once you finish the questions, you're welcome to share. Oh, that's me. Okay. Let's see. Risk management. Yeah, I think that's it. Yeah. So that's what I have for you today. Thank you all so much for attending. I hope you found this helpful. But as I repeatedly said, please reach out to me via that email address. You can see me on social media. I'm at Twitter at DLundgren3333. You can follow me on LinkedIn as well. And we have our Motor Capital Management page on LinkedIn as well, where we post the CMIs, the week after they're published and whatnot. So, but this is a tough business. I've been doing it for 30 years. I'm about a tenth as good as I hope to be in the future, but I have been doing it for 30 years, and that's the thrill of this business, is that you're constantly getting better. And I can't wait for tomorrow, because that's what it's all about, constantly improving. And if I can share with you the things that I've learned over the 30 years, please reach out to me. I'm happy to help. Thank you so much.
And on behalf of the CMT Association, I'd just like to extend our sincere thank you to you, Dave, for today's presentation. From presenter to board member, committee member, podcast host, Dave's commitment to our organization is truly unrivaled.
Thank
to
you.
Our audience, yeah, no problem. To our audience, for those interested, today's presentation has been recorded, and it will be made available in our video archives a little later this afternoon. If you do have any additional questions we could not get to today, or that you think of while watching that archive, please feel free to email them to me or any member of the CMT Association staff, and we'll pass them along on your behalf. Alternatively, Dave has been gracious enough to share his email, which you can see on your screen right now along the left-hand side there, or you can find him over at Twitter, which I've posted in the public chat. I do encourage each of you to show your support for Dave by checking out his company, Motor Capital Management Research, over at motorcmr.com, and take advantage of this free trial. With all the noise that's out there on Twitter, I believe you'll find it truly refreshing to read real quality research. For the CMT Association, my name is Shane Skwarek. I thank each of you for spending the hour here with us, and hope you enjoy the remainder of your days. So long, everybody.